Welcome to another edition of The Balanced Perspective. I'm your host, Mansoor Nak of Nedgroup Investments. As usual, we're joined by Iain Power, the CIO of Truffle Asset Management. Welcome, Iain.
Morning, Mansoor, and morning to everyone joining us on the call.
Today's topic, threading the needle. Iain, a lot has been said in the recent past about inflation and interest rates, and of course the impact they could have on the markets and economies. Yet, despite what we've seen so far this year, markets, at least looking at the US, have certainly remained resilient, and the economy there seemingly moving in lockstep. Just listening to Fed Chairman Powell following the last Fed meeting, it seems they're a lot more confident in their ability to deliver a soft landing, despite the hawkish undertones of not ruling out more interest rate hikes. Iain, what's your assessment of where we're currently at this point in the cycle? And do you think they're being a bit overconfident in that assessment?
Mansoor, I think if we sort of look at the data and what's come out over the year is we've seen really a US economy which at a GDP level is certainly reflecting stronger for longer. So, I think the US has almost become the cleanest dirty shirt in a world where, Europe is increasingly struggling and tied to China, which is very lethargic, and where we haven't seen the fiscal support from the Chinese government that we expected to see. And the US really enjoying the benefit of a significant fiscal impulse from the government through the big fiscal deficits that they're running, the Inflation Reduction Act, and all of the money that the government's pumping in. And that's at a time when the consumer has still been running down all of their COVID relief payments to the extent that, that has obviously supported consumption. So I think that's really what we've seen come through in the numbers, and that's really culminated in a very, very strong US labor market. And I think, if we look at the data, we'll see that US wages are still growing at sort of circa 4.5% per annum, which is well in excess of the Fed's 2% inflation targets. And I think some of the rhetoric that we've seen from the governor has really been talking to this point that, the US economy is managing with higher interest rates, and perhaps some of the reason for that is because a big chunk of their population hedged their mortgages when rates were very, very low. So I think you've got sort of 60% of US mortgage holders which are paying sort of below 3%, which has made them relatively immune to the big change in interest rates that we've seen come through in what has been one of the fastest rate hiking cycles in the history of the Fed. And I think the resilience of the economy and the consumer to a large degree can also be attributed to the piece where, consumers have effectively sterilized that impact of the higher interest rate hikes. And, when we look at other parts of the economy that haven't had that same protection, if we look at credit card delinquencies, if we look at auto loan delinquencies, if we look at US bankruptcies from a corporate perspective, they are all doing what you would expect them to do after a very, very strong and sharp rate hiking cycle, which is start to really show signs of distress. So I think that's what we're seeing. But at the same time, you've got this shortage of labor in the US. You've got onshoring. You've got lots of other factors. You've got declining demographics. All of these things which are sort of pointing towards a labor market which is more resilient and where labor feels more comfortable to demand higher wages in the face of what's been a higher inflation cycle. And also, if we look at the anecdotal evidence of all the social and strike activity right now, there's a strike happening in the US auto workers sector where north of 25,000 workers are out on strike, and they're looking for a sort of a 40% increase in their pay package over the next 4 years with a 20% reduction in their work week. So all of these things sort of point to a US worker or laborer that is feeling confident. They're in a strong position. There are lots of jobs. And they've felt the brunt of high inflation, and they're wanting to get higher wages. And I think that is a worry for the Fed. And I think that's why you've seen them change their dot plot, and all those rate cuts that everyone was expecting into next year have now miraculously disappeared. and we might even see another rate hike towards the end of the year. And on top of that, I think markets have been very complacent in terms of some of the valuations and I guess what people were pricing in, and a combination now of perhaps the realization that rates are going to be higher for longer, and particularly real rates now pushing over 2.2% in the US, I think is starting to, equity markets are starting to show some cracks, and we've seen the S&P, sort of pull back about 7-8% from its high.
Iain, despite the rosier outlook, at least from a GDP growth perspective, yield curves remain deeply inverted. Do you think it's a case of a recession, even a mild one, postponed rather than not happening at all?
Yeah, I think, Spencer, the thing to always remember, and in my 30 years in the markets, is recessions are almost, by definition, impossible to predict. And when I say predict, I'm talking about the timing. And often, people will only realize once they look back at the data that, we actually were in a recession, and was this a sort of a soft one or a hard landing? It is only evident after the fact. And the thing that causes recessions that don't happen by themselves is higher interest rates. And I think that's perhaps one of the things that maybe the market's starting to worry about is the message from the Fed is that they're going to do whatever it takes to get inflation down, and that may well mean putting the US economy into recession. And time will only tell whether it's a soft landing or a soft or mild recession or a harder one. But the one thing that history does suggest is when you have big rate hikes, things tend to break, because cost of financing then goes up significantly. And for those businesses who perhaps have to roll debt at now an inopportune time when perhaps rates, their historic debt on their income statements or balance sheets, the cost of that debt was low, and now suddenly it's going to be very high. And perhaps the appetite now to roll that debt is much lower. And if we look over the next 18 months, we can see two big events in the US unfolding. The one is almost $800 billion to $1 trillion of commercial real estate debt, which needs to be rolled. And then secondly, some corporate loans to, about another $800 billion. And they're going to be rolling into a market where the appetite for taking that debt is going to be a lot lower. And, we would expect at this stage, late stage of the cycle, and perhaps into 2024, when we do ultimately see a recession, is you'll see credit spreads blow. So I think that will, sort of culminate into some sort of credit event and perhaps a little bit of a liquidity event. And, interestingly, the banking crisis that we saw in the US in the earlier part of the year, which was really precipitated by higher rates, and perhaps some of the regulators realizing that those regional banks capital positions were not what they should be, that situation's got even worse because long-term rates have moved even higher. And I think there'd probably be more concerns with those banks, most of which, have financed a lot of their commercial real estate into next year, where they now have to roll some of those assets, and, perhaps there's some big write-downs coming. So, banks are sitting on very little capital. And I think, who knows what it's going to be that will cause the camel to stumble here. What is the last straw? Is it a credit event? Is it a bank event? Is it higher oil prices? There's so many, but really what we can look at is we can look at some of the valuations, and we've been saying, throughout the year that they're very expensive. They're not pricing in some of these risks. We've been very cautiously positioned. I mean, certainly that hasn't been right, particularly in the US. I think more recently it's starting to really reflect some of the concerns are starting to be reflected in asset prices. But we think that there's probably some more pain to come.
Iain, given that the cycle is long in the tooth, and you mentioned things breaking, and I suppose related to the previous question, are there any cracks that are starting to appear, beyond, I think, some of the obvious things that you mentioned earlier?
Yeah. So I think, I mentioned some of the high frequency data in the US where we can see consumers feeling the impact of those high rates. So credit card delinquencies, auto loan delinquencies. I mentioned some of the insolvencies or bankruptcies in the US. They're starting to accelerate. And I'll give you one stat. Credit card delinquencies of the age group 35 and below are now at GFC levels. So that sort of lower age demographic from sort of the 20-year-olds all the way up to sort of the just below the mid-30s are really starting to feel pain. And I think if we look elsewhere around the world, where perhaps consumers haven't had the ability to hedge their mortgages, for example, in the US and in the UK and some of the European countries, you really are starting to see some of that pressure come through. So I think the higher cost of funding, slowly and really eats away at companies' balance sheets, particularly where there's leverage. And I think companies that find themselves with lots of leverage are now perhaps in the hope that rates by 2024 would be coming down sharply, are perhaps now in a bit of a panic. To the extent that they're going to have to roll lots of this debt into, a significantly higher interest rate at a time where perhaps the lenders or the providers of that capital, my sense is, are going to be less willing to provide the funds. So I think, it's classic late cycle stuff. Lots of complacency. The VIX is pretty low, but looks as though it's sort of, starting to base and perhaps start to move up. These are all signs for us that this is a long old cycle, and whatever the thing is that cracks it, you can never tell. There are lots of things. But, in hindsight, we'll be able to look at it and say, well, this was pretty obvious. The ensuing, I guess, cleanup or clean out of the unsustainable assets and businesses, etc., is just a normal, healthy part of a cycle.
Iain, given what you just mentioned, how are you adapting your strategy to navigate through what remains a clearly difficult environment to invest money in?
Yeah. So, Mansur, we've been defensively positioned, as you know, going into the year. So, we were early in terms of, I guess, battening down the hatches. And for the first 6 months of the year, I think there was a big risk on, and we saw, significant upward re-rating in many of the global equities, lots of which has now started to come back. I think MSCI World's now come back quite a lot since its peak, and I think a defensive positioning is the right one to have right now, because as you mentioned, yield curves continue to steepen, or the bear steepening as they call it, and I think it's really reflective of the fact that we've got a situation on our hands here where at some point you're going to see some sharp weakness in the economy. In other words, the way I like to describe it is if you slowly pile on straw onto the camel's back, the camel can take a lot of straw, and often it's that one last piece of straw that causes it to suddenly collapse. And I think it's going to be the same thing. So the weight of the increased cost of debt will definitely have its effect, and we're likely to see that precipitate into 2024. And of course, we've got all sorts of other factors, as you know. We've got US elections, we've got a conflict in Russia, which is getting old. We've got oil prices, which are up 40% since July in the US. These are all things which could have a significant impact on asset prices in the US, which by all accounts are still pretty expensively priced, which to us would suggest, still holding the line and keeping a relatively defensive positioning and focusing more on capital preservation rather than chasing returns.
Iain, to bring it back home, one of the things that you've been quite worried about for some time is SA's fiscal position. And I think we have, the medium-term budget coming up in November. Of course, we've got one more SARB meeting coming up as well. What's your view on what's clearly a very difficult position that we find ourselves in domestically?
That's right, man. So I think, we obviously find ourselves in a difficult position here where corporates, particularly in the corporate sector, profits are down significantly because of load shedding, and on the mining side because of lower commodity prices. And there's going to be about a 30 billion, we think, hole in the tax receipts for the year, and that's at a time when government wage bill continues to grow, and the pressure on still keeping social grants into an election year is probably going to remain pretty high, which I think is giving the market, and certainly our bond market, concern with respect to the sustainable debt levels that the country can carry. So I think it's going to be an interesting medium-term budget discussion. And what we're expecting to hear from the finance minister as well is there's probably going to be potentially some tax increases coming into the new year, and perhaps some budget cuts to then try and cut one's cloth for the situation that we're dealing with. But we do think that we're probably at the worst point looking at corporate profits because of load shedding, and perhaps that getting better next year. So we think that will probably improve slightly. And one of the other positives, just to mention, is that if you look at personal income tax as well as VAT, they've been a lot more resilient and sort of suggest underlying health of the consumer here, notwithstanding the issues, that is still okay. So I think, the corporates will sort of rebound into 2024, 2025, and also meeting with the head of SARS, Edward Kieswetter, over the last 2 weeks. One of the points that he mentioned, which is I think worth noting, is SARS believe that there's still about 300 billion rand on an annual basis that is evading or escaping the tax net. So through better tax collections, they've employed a lot more people. They think that there's additional tax recoupments that can come into the system just by enforcing better tax compliance.
So definitely not all bleak news, and lots of food for thought there, Iain. Iain, we'll leave it there. As always, we thank you for your insights and your expertise. Always a pleasure listening to you. Till next time, thank you and goodbye.
Thanks, Mansur, and thanks to everyone joining us this morning.